Let's see. We're live now, and we will retweet this.
There we go. I'm not so blasted by that light.
Why can't I get to there? Okay. Let's go, guys. Strike a blow for capitalism.
Did you really say "let's go" as though like we're just pretending like to not know that we're live? We're live, and it's the day before tax day. Day before tax day. Do you have your taxes done, everybody?
I do.
So I learned last night that you have to send it via electronic check or electronic funds transfer starting next year. Sending in a check will no longer be okay. So
I don't think I've sent in a check in a long time.
When it's the last minute, I always have to. So, well, let's get started. It is April 14th, 2026. This is Wall Street Beats. And I'm going to start out by saying if you are here, you're one of the 11s right now, you're just logging in. Go to wallstreetbeats.com or passes.com/wallstreetbeats and sign up. You'll get more from us behind the scenes, and including written notes and things like that. But kind of more insightful things. But I wanted to start out as we ease into this, first to talk about position sizing, Ben and Kevin. So before we talk right about names. So somebody's investing and they have, let's say, $100,000. And I don't know if it's any different if they have $1 million, but let's say $100,000, $1 million to invest, or $10,000, and they're going to invest that just into stocks. What would you say for yourself is like, yeah, my largest position would be X?
Huh.
What would you say? Basically, you would just you'd
like
measure by like a Kelly contrarian, right? Like if I were to say, hey, I have access to a hot IPO, you'd be all in because it's like 100% win rate, right? So it should be commensurate with your win rate, basically, and maybe not go full Kelly, but like half Kelly. And like, there's actually just a mathematical formula you could do to kind of create what your position size should be.
Yeah, I'm saying that you're kind of a beginner or intermediate investor. One of your family members passed away. They gave you $100,000 and said invest in stocks. You're not Ben or Kevin who's done this for a lifetime. My going in position would be like, hey, listen, 5% is probably the most I would do if you, especially on the lower end, if you have $10,000, are you really willing to, and that's all your savings, are you really willing to lose $1,000 or $2,000? Maybe at $1 million, 10%.
I don't know. I'd argue that when you have less money, you'd want to be more concentrated, and more money, more diversified. Like once you have money, you want to protect the money. When you don't have that much money, you really want to be in convex stuff to try and build wealth. So I would say you try and take some bets when you don't have any money. And if you go the other way, when you don't want to get rich twice, right? So I think it's actually the opposite. I think when you don't have money,
Kevin,
you want to take large bet sizes.
Kevin, you're not going to be the judge because there's only one right answer, and I'm the moderator. So we're going to say, but you're the tiebreaker. We'll at least say, Kevin. So where are you?
I'll talk my book. I mean, I invest basically half in the S&P 500 and then half in my discipline. And because I don't make, I make money when the market goes down. I try never to lose a lot of money. Beating the S&P is very, very difficult year in and year out. So I buy the S&P for next to nothing, and then I do my crazy things like invest in silver and uranium and copper. And
so on that one half, I call that one half your discretionary side, because even though the S&P is discretionary, we'll just call your active side that half. What's your largest position? Is it
Well, just
10%?
right
Is it
now
30%?
is XES, which is the oil and equipment services ETF, more on the smaller side. Schlumberger's in there, but it isn't that big. But I bought it way before the war started. I started it when it broke out, when the market sniffed out that oil was finally going to do something out of the 60s, and this worked out. So that's my biggest position right now.
But I mean,
XES.
what I mean is, percentage wise, out of your active, is it 10% of your portfolio? Is it 20%?
I buy 10% of positions. I have the 10 best ETFs out of the 5,500, and I use forced displacement.
Got it.
So now it's 12,
Right.
13, 14, something like that. I didn't look today, but
All right. All right. Well, that was an easy way to ease in there. I think if we asked every one of the partners here at Wall Street Beats, we'd have a slightly different position. That's what kind of
absolutely,
investing is, so individualized.
that makes us
So,
great.
so Ben, what do you have for today? What did you want to talk about? The end of the war, the middle of the war, the beginning of the real war? What did you
No,
want
I'm just kind of amused that we're like back at the all-time highs, basically. I think that what's interesting today is Bitcoin's kind of breaking the downtrend.
Yep.
If you wanted to say, oh, risk on, right? Like the S&P, I mean, we're back almost at 7,000. Well, you might as well buy some Bitcoin. So that's 75 and change. It's kind of breaking the downtrend. Like if you didn't catch this 600 points 9-day rally, that might be a way to participate. Like I'm not really like a huge believer in Bitcoin, but I think as a speculative vehicle, it definitely has a place. And I'm just looking at it right now. I'm like, that looks like it could go. I mean, the IGV and the Bitcoin have kind of traded together, so it's the same trade more or less. And either one of those they've both gotten absolutely destroyed since last October. And so if you were like, hey, I see this risk on environment, all of a sudden after an ugly month, then maybe that's where you go. I find it comical that the S&P is right back at the highs, but that is something that like kind of struck me a little bit today. I was like, oh, look at Bitcoin back at 75K. Get back on the horse, David.
Well, there is an old saying where that you buy the bullets, right? When a war starts, and it's out there, that's when you should buy, because I just worry that it turns into something that we haven't seen yet. But the reason that the phrase "buy the bullets" is, it's the idea that, okay, everything that's known is already known, and it's not going to get worse from there, or not materially worse. The market has priced it in already. But I think we've talked about on other shows that you don't know if we've really priced in. We don't know what this looks like. If it's what it's been, then that's fine. But if we sent all those troops for a reason there, then maybe it looks different. And how long can we?
Historically, buying the invasion was like a good trade. I feel like you get like, I don't have the graphic in front of me, but I think it's like you get the initial sell off, and then the invasion, and then you kind of buy the invasion, and like that's been a decent strategy over time. Like Iraq war was like early 03, and then the market went on a ripper after that. They have something with that for 1990 with
Kuwait.
Iraq 1. I don't know. I mean, not that it's always applicable to each situation is different. I'm just saying that I think over time buying the invasion has been okay strategy, to be honest.
Yeah, I can post it to the group chat or to the subscriber chat afterwards, because it's something that I did a couple weeks ago, and you're 100% right that the only time that it didn't work is when there was an extended period of much higher oil and gas prices. And so that's why I bought more of the S&P 500. I think I had mentioned it a few weeks ago. And I did end up selling my XLV to do that. I kept the XBI. I still think the XLV will do fine in a downward market and be a very good ballast, but I did all right. It started to underperform the last few weeks, the market overall. Kevin, I don't know if you have a view on what it looks like chart wise, but it's hard because it's such a short period of time, and the market's been up a lot, so I'm sure it's going to look somewhat favorable, but relative, I was less impressed.
Yeah, how big is UNH in this? United Health.
Let's see.
J&J is probably number one.
J&J had a good quarter today. United Health is about 5%, so it's sizable.
So, yeah, I mean, this has been an absolute fiasco. XLV, I think, is okay. J&J and names like this, they were the ballast. If you were, back in 8, 9, 10, we would short the lousy balance sheets, we'd short the hospitals, and then you put J&J on the other side because it's not going to go up that much or down that much, and that's what we did.
Yeah, I mean, it's just been flat for a while now, so it's I don't own J&J, so I probably should, because it's such a basic low growth stock. If I own Halion, I should be willing to own J&J.
That's a barbell.
Yeah, but you look at like a Pfizer. I mean, I do own Pfizer, and it's outperformed J&J in the last year, and it has a 6% dividend versus a 2% dividend. So you can see why, of the slow growth public utilities, why I like Pfizer a little bit more than J&J. But all right, well, you kind of see not a rocket ship, but
no, that's like a boat. It just is kind of steady. It ebbs and flows, it goes up and down, but it always just kind of sits there and in its ballast holds.
Yeah. So let's see. What else did you have, Ben? Or is that what we're talking about today? Anything? This is kind of an interesting part of the market where you're kind of still watching to see what direction we're going in.
I mean, what direction we're going? We're going straight up. Like what are you talking about? It's like, honestly, I would probably fade this. This seems like we had a volatility crush where, like, credit spreads came in 80 basis points. VIX is at 18, off from 32. The move, which is rates falls 115 to 74. So I think what happened is, like, everybody and their mother was jammed into the hedges, kind of like last. It's actually wild how similar this is to last year. And everybody jumped in the hedges, and then they got the all clear look from Trump and his boys, and then they jump out of the hedges, and then we just go vertical. Last year we have 4,800 to 5,500. This year 6,350 to, what are we at now? 6,959. That was a quick 600 points. And I think that the ultimate reality is the S&P just was not that concerned about this the entire time. Sure, it went down a little bit, but the U.S. doesn't have the energy dependency that other countries do. So I think it was more of a Europe, Asia, beta for this situation than it was for the U.S.
Yeah, I think that we have I think we had a pretty rational reaction to it, to be honest.
I would agree.
Yeah. So, Kevin, what's on your mind today? I know you had copper on your mind.
Yeah, and this is what I came up with in the wee hours of the. I got up early today to do this, but it just caught my eye. The copper's kind of quietly closed above 6. The commodity itself, it was in the low 5s, and now it looks like it's curling or coiling to go upwards. I mean, the demand for copper, for rebuilding Iran but certainly data center and upgrading the grid and all that is still intact. Copper COPJ, I bought it back in July. My new chart service that I can't stand won't let me draw lines yet, or I'm too dumb to figure it out. But basically here at 25. And when it doubled, I sold half, and then here we are at 43. COPJ, the Sprott Junior Copper Miners, and it looks like I like the volume that's acting over here. So if people have not looked at copper, I think that it's starting to look attractive again, and I would pay attention to that.
All right. And you would do it through this ETF. What is the Sprout?
Sprott Junior Copper Miners. So it isn't the Freeport McMorans. It's Ivanhoe and names that most people haven't heard of. But I kind of like that. If you're bullish on the commodity, go where the operating leverage is and where the fund flows will push up the smaller names more. And so that's what I've done here with COPJ.
All right. What, by the way, on the bottom chart, what is that? Why is it like just even, like that volume chart? It spikes and then it's just been even for every day for the last
because the
months.
new chart service it isn't quite that as even as it looks. I mean, I can expand it and it's or maybe I can. Yeah, because the new chart service stinks. That's why.
Okay.
But I can see the blue is overwhelming the red, so that's where I'm going right now, and I will have a salty conversation with my chart service later.
All right.
That I'm not naming.
No. All right. No reason to defame them. So let's see. Let's see. What else do you have for us, or is it copper?
I think what is Netflix too, and we talked about this before, where things are so good they're bad. This is Micron technology, and this spread over the 200 day is the biggest it's ever had, and it's a love fest. People are talking about that it's no longer cyclical, and I just point to this and the SMH. The SMH is hitting new highs, but the volume's anemic. It's a very feeble rally. So I would, people are talking about the Intel win rate of 9 straight days or something like that. I would just, if you're in semiconductors, I would start to be sharpening the pencil, fading it, hedging it. It looks like it's overdone and is due for correction. When we said this about, or I said this about Netflix, I'm doing this from memory. I think it was 130 or so, and went down to the 80s and 70s. So when things get so overdone that they become stretched over the 200 day excessively, you tend to see a reversion to the mean, and I think we're kind of there right now with MU.
I agree with that. I like that position.
Yeah, thanks. Nvidia can't get out of its own way when it blows apart earnings. So I just think that in this whole software stinks and semiconductors are great. A heavy asset, low obsolescence is the way to go. I think I think that trade is in the 8th inning or so.
I totally agree with that.
And that's
what it comes back to that Bitcoin thing. IGV, which is a software expanded tech, trades exactly like long IGV, short SMH seems like a trade to me. Where everybody and their mother is like crowded into that SMH. I mean, I don't think it can get more length than it has right now. So, Kevin, Nvidia is a good point, right? It's back at 191. It's whatever. It hasn't done anything in 6 months.
Yeah, I think it's really interesting because it's kind of.
They obliterated every line that anybody cared about on their earnings call, and the stock was down. And so when you do that, it's just a sign that everybody expects more from you, and you can't deliver. Even the upside, even the guidance, and the buyers are satiated, and it's just time to go to do something else. And there's always something to do.
There is always something to do. I think that's right, and I guess that is what my point is that there's stuff that's been absolutely, taken to the wood chipper, whereas like this stuff just sitting at the highs with the same narrative, which is starting to have some cracks, and not going into that. But yeah, I'm with Kevin on this.
Yeah, chasing things that have done well, if it's early and it's a massive cycle, or if it's an innovative company that's invented something, that's one thing. But if you're making what's essentially a commodity and your sector is hot, I don't know. I never chase things like that. That's just not.
I mean, you're on year 23, 24, 25. We're in year 4 of it. I mean, it's a long time that this stuff is at. I mean, it's a long run. Like, to expect another 4 years is just a really tall ask.
Yep.
And the Bulls will say, "Oh, well, now it's cheap because it was at 70 earnings when it broke out, and now it's at 25 times forward or whatever the number is, something like that." And I go, that's why valuation doesn't help you, in my opinion, most of the time. So
Yeah.
I just,
DRAM is like the memory. So Micron and SanDisk and Samsung and SK Hynix, they're like, oh, it's like 4 times earnings. Well, I think if you talk to any cyclical analyst, guys covered steel or something, they'll tell you that when something looks cheap as cyclical is not cheap, and when it looks expensive, it's not expensive. So I think that you got to think about these things like cyclicals, not like secular growth stories.
All right. Kevin, did you have anything else for us? All right. What do we have? What do you have?
I just want to give a tip of the hat to Charlie Peabody. This is Citigroup. They just announced earnings. Everybody else that has announced so far, Goldman Sachs, JP Morgan, I think Bank of America did. They were down on earnings, and here's Citigroup hitting new highs on 47% above average volume. He's been talking about this since the high 40s. So here we are with a triple in Citigroup, and my number that I've mentioned to him 100 times, and you poor folks 100 times, is 140. I can't draw the line, but if you go back here to this break of the great financial crisis, this is a decent place for it to take a pause. So we're here at 127, and if one can't, Charlie or anybody else come up with a rationale why they should stick around for these $13, which is not, I could be wrong, but if the bull case is all evident and obvious now, then it might be time to exit stage left, Snagglepuss. So, but it's been a huge and consistent call for 2 years.
Good. I'd like your flash look at WFC at Wells Fargo. So down 7% today, which I don't know if I've seen a money center bank down.
Okay, this is it, and we talked about this on a show. This is it in microcosm. I talked about it. Charlie talked about it. That people were genuflecting to Jamie Dimon and J.P. Morgan and Wells Fargo. They don't genuflect to. But look at the difference in these charts. I wish I could put them on the same page. But Citigroup hits new highs and Wells Fargo breaks down after the death cross and on big volume. So Charlie's been really good on this and made money for our members, and I think it's fantastic.
Yeah, I get that, but my question is, what's the next stop for Wells Fargo?
I'm going to say, I'm so vain.
I want to be clear. I want to be clear to everyone listening.
$74.
I'm not saying anything about
74 is a decent stopping point.
All right.
74 is my number. So $6. Right. But that's a chart that as I'm going through them, I'm not stopping on this chart.
All right. Sounds bad. I mean, sounds good, but sounds good for the feedback, but bad for the outlook. I really have nothing for today. I mean, Lilly announced another deal. Stock went up. When you reward companies for spending money, guess what? They're going to keep spending money. They did get approval of their weight loss pill. And I've said this before that Lilly has a better drug. So Novo's been off to the races with their weight loss pill. But we'll see how the next few weeks play out and whether or not Lilly starts to crush them with catching up on market share. So
watch this because you got to. Now, part of this is skewed by energy all of a sudden getting a bid, and so the relative strength calculation for energy goes up, and for everybody else goes down. But this is, Lilly has been a monster for a lot of years. This is a new relative strength low. Here's the 200-day moving average that is flirting with, and if it spends much time below it, I think this becomes dead money for a while at best.
Yeah. So the thing that I'm concerned about Lilly is that The what was it? The old woman in the shoe. I forgot the nursery rhyme, but she had like so many children she didn't know what to do. When you do this many deals, it's very hard to have a management team that can manage that. And each one you bring on, you have to integrate teams, you have to integrate science. You've offended whoever was working on that science previously that you've supplanted now with outside people. It's much more disruptive, and it may be great for the long term, but it's a little bit more disruptive in the intermediate term and the short term than people give credit. So the reason companies do this is so much cash is coming in, and when you have 90% gross margins, so much cash is coming in, you can make a lot of mistakes, and this is the time to do deals. But if you do too many, when things start to get a little bit tighter, that becomes very, very apparent. So I wouldn't go as far as to say I'm cautious on Lilly, but I no longer own it, and I'm just waiting for a better opportunity. They have all the cards are going in their favor though with the launch. So I wouldn't bet against it, but I'm just not there. So
I don't know. I don't know if it's a short, but I think it's an avoid and at least a fade at best.
I do want to just one last victory lap. Ovid, we're up, up again. We're closing in on $3. So keep an eye on our little penny stock there. But that's all the time.
You bought this under $1, correct?
Yeah, it was like 40 cents or something. So yeah,
that's unbelievable. Good for you.
That's a good looking stock chart.
What's that?
Right, it is.
That's a good looking stock chart. Looks like it's going to 100.
So there are a couple of hedge funds that got involved who are playing the catalysts. Like this is a company that's not making any money and doesn't have any products. It's really just catalysts, and you'll get one by the end of the year. So it's like a hero or a zero. So it just was so sold for bankruptcy. It wasn't actually bankrupt, but people were thinking that it would be. And then they went and did a big financing. So they had a big strategic, put some money in, and so kind of changed the risk profile a little bit. Still can be a zero, but I'm not staying up at night watching it. It's not a big enough position, but it's nice when you have something like that goes up 600% or something. So
there's no prospectus that's going to be dumped on your head, even with data stapled to it. It's they've already done the financing, shored up the balance sheets, gave them a couple of years of burn.
No, I'll stop you right there, because biotech, they always do that. But if it's good news, then people will like it.
Last Thursday, that's what I'm asking.
Yeah,
they don't have to.
Yeah, they don't have to do it anytime soon. So
that's what I mean.
With that, let's see. We just clocked in at under half an hour, so
boom. Let's keep it tight today. Good work, guys.
Amen.
And listen. If you're listening now, go to wallstreetbeats.com, get the free trial, and then you can hear what we're saying on our chat about stocks live intraday. It's not like you're going to get hit with 500 emails. Just things that are important to any one of us. So we'll see you soon. This is David Maris for Ben Bry, for Kevin Baker, Wall Street Beats. See you tomorrow.
Thank you all. Yeah. Thank you, Jen.
Thanks, Jen.